In this video, I am going to detail the key 2025 year-end tax planning tips that every taxpayer and every retirement investor, including self-directed retirement investor, must know. This is crucial. I'm a tax attorney. Not only have I written 9 books on self-directed retirement topics, but I also have a master's in tax law. And this is what I have focused on, is helping not only individuals, but small businesses maximize their tax positions. So 2025, the maximum you can put away is $7,000 or $8,000. But here's the good news. You don't have to even do it before 12/31. You have until April 15th. So I got you. I scared you. You don't have to make IRA contributions until April 15th. But it's a good time to start thinking about it. Okay, year end, I got Christmas presents. I'm going to have holiday parties. Can I put away just a little bit more money in January, February, March, or even early April to put into an IRA or Roth IRA? Why would you want to do that? The more money you put away, the more money is going to grow without tax, the more money you're going to have when you need it. And this is how you're going to build wealth. Let's now move to 401k plans. Employee deferrals. If you have access to a workplace plan, you need to make employee deferrals, which is $23,500 or $31,000 if over 50 in 2025. Those must be made before 12/31. Unlike an IRA, you don't have until April 15th. So you have a couple weeks left to make those 401k contributions. Talk to your employer, your human resource department, plan administrator to make sure and identify if there's any lapse or if you have any room to make additional contributions. If you have a solo 401k and you are a C Corp or S Corp, also your employee deferrals must be made before 12/31. Your profit sharing, that 20 or 25%, or the mega backdoor, that could be made until April 15th or even October when you file your final tax return. But the employee deferrals, that 23,500 or the 31,000, must be made before December 31. Okay, so keep that in mind. Now let's move to another favorite topic of mine, and that's capital loss harvesting. Okay, so you should be talking to your financial advisor if you have stocks or investments. You want to make sure that if you have some loss positions, maybe you want to take them now, and then you can absorb and eat up some of your gains, because most of us are up 10% plus in the stock market. So this, if you have a couple losing positions, which I do, you could actually offset and sell some of those losses and offset the gains. And you can also use some of those capital losses to offset up to $3,000 of ordinary income, which is a great thing that every American should do. Every taxpayer should be taking some capital losses and use it to at least eat up $3,000 of ordinary income. If you have on top of that, then you can mismatch your capital losses for your capital gains. So hopefully you're in a position where you're not paying as a lot of taxes on your capital assets. You then, under the wash sale rules, you can then wait 30 days and repurchase that stock, right? So let's say you own company XYZ. I don't want to say Apple or Nvidia or Google because they've been up all year, but let's say you have another stock that's been down. You can sell it, use the loss to absorb $3,000 of ordinary income or other capital gains, and then buy that stock back within 30 days, which is something everyone should be doing. So that's something I totally believe is crucial. One other thing I want to jump into, which I should have talked about before capital losses, is Roth conversion. If you want to do a Roth conversion, which means moving pre-tax IRA or 401k money to Roth, yes, you have to pay income tax on what you convert. That needs to be done by 12/31. Why would you do that? Well, of course, the idea is once everything's in Roth, so long as you're 59 and a half and the Roth has been open at least 5 years, everything is tax-free. So yes, you do have to pay income tax on what you convert, but you can also potentially get discounts if you have liquid assets like real estate or other types of investment funds or even stocks in an LLC. You can potentially get a discount on what you're converting, or maybe you have losses to eat up some of your gains. A conversion is a nice option. I actually just spoke with a client. I own some real estate, and she was able to get a 40% discount on the valuation. And then she had losses from her business startup that she now, based off the new tax law changes, was going to be able to use those losses to eat up any of her Roth conversion gains. So this is something she was going to pursue in 2025 versus waiting to 26 and 27. So there are a lot of great tax planning opportunities. And yes, let me just say this for the record. This is why you want to work with a company like IRA Financial, because not only are we setting up self-directed retirement accounts, we're also giving you tax consultation and compliance assistance throughout the year. So we're with you. We're your partner. We're staying in the game with you to make sure they're not opportunities that you're missing out from a tax planning standpoint. Require minimum distributions. If you're over 73, you got to take them before 12/31. If you're a client of IRA Financial, we'll help you. We'll calculate them for you. You have to do it on all your IRAs and all your 401ks separately, generally around 3%, but we will assist you. It's only for pre-tax accounts. If you have a Roth IRA, there's no RMDs. You should also review your tax bracket, right? Where are you? Where do you think you'll be? Are there any potential bunching of income, or especially if you're a cash taxpayer, can you delay some income to 2026 so long as it works from a business standpoint so you don't recognize the income in 25 and you can recognize it in 26? Last thing I want to mention that every investor should be doing, especially self-directed IRA investors, is just kind of going through your checklist, right? Beneficiary forms. Has anything changed in your life? Divorce, separation, death. Do you have the right primary and contingent beneficiary for your IRA or 401k? That is crucial, because even if your will says something, if your beneficiary form says something else, your beneficiary form ruled and controls. So you need to always update that. And end of the year is a great time. Also, if you made contributions or you took a distribution, just make sure everything's in order. Of course, we're going to report everything on the 5498 or the 1099, but you just want to make sure, did I do everything right? Is everything documented? Do I know where it all is so I can give it to my accountant? In sum, this is a great time not only to enjoy the holiday season, be with family, great holiday parties, but also take stock of kind of what happened in 25, what you can still do, and then what you want to do in 26. The contribution numbers are all increasing in 26 across the board, from IRAs to 401ks, SEPs, simples. So this is a great chance moving forward to 2026 to keep the good habits going, keep contributing, and focus on putting away more in your IRA or 401k, and also at the same time thinking about, from a strategic position, Roth conversions, charitable contributions, and all other potential tax opportunities from an individual standpoint that could be of assistance and help you not only generate real tax-deferred retirement wealth in the future, but also generate important tax deductions for 2025 and beyond. Ready to jumpstart your year-end tax planning? Schedule a free consultation with IRA Financial. We'll guide you through what documents are needed for what accounts, explain the steps to keep everything organized, and help ensure nothing slips through the cracks. You can also download our year-end tax prep checklist to stay on track, start the new year confident and prepared. Thanks for watching the video.